You know that feeling when you're lying awake at night, scrolling through social media, and suddenly every single person from your high school is posting pictures with keys in their hands, big smiles, captions like "we did it," and homeowners at last. And there you are, in your rental apartment, and this weird cocktail of emotions hits you. There's genuine happiness for them, sure, but underneath, there's this gnawing anxiety, this quiet voice whispering, am I falling behind? Should I be buying a house too? Is everyone adulting better than me? Here's what nobody tells you about that anxiety, and honestly, this might be the most important thing you learn about money this year. That feeling isn't actually about the house. The real trap with home loans isn't the interest rate or even whether you can technically afford the payment. It's psychological. It's what a big mortgage does to your brain, your career flexibility, and your ability to build actual wealth during the most critical years of your life. And if you understand this before you sign, you can avoid a 30-year psychological prison disguised as the American dream. My name is Neo, and I spend way too much time thinking about money, specifically about how we make the biggest financial decisions of our lives based on emotions we don't even realize we're feeling. If you're someone who wants to build genuine wealth and freedom instead of just checking boxes that society tells you to check, make sure to hit that subscribe button and give this video a thumbs up if it ends up shifting how you think about what might be the biggest purchase of your life. Most financial gurus will tell you that buying a home is the cornerstone of wealth building. They'll say you're throwing money away on rent and paying your landlord's mortgage. The conventional wisdom screams that home ownership is forced savings, that your payment stays the same while rent keeps rising, and that if you can qualify for a mortgage, you basically should. But here's the thing they're missing, and it's massive. The conventional wisdom around homeownership is based on an economy that doesn't really exist anymore. Most people think the biggest risk of buying a house is whether they can afford the monthly payment. They run the numbers, see that the mortgage is only slightly more than their current rent, and think, okay, we can swing this. But that's not the trap. Here's where it gets interesting. The real trap is what homeownership does to your psychology, your risk tolerance, and your ability to capitalize on opportunities during your peak wealth building years. The house doesn't just change where your money goes, it changes how your brain works. And once you see that, you can't unsee it. Here's my core thesis, and I want you to really sit with this one. The home loan trap isn't about the interest rate or the down payment. It's that a large mortgage fundamentally rewires your relationship with risk and opportunity at the exact moment in your life when you need maximum flexibility to build real wealth. Psychologically, a big mortgage creates what behavioral economists call a commitment anchor. Your brain reorganizes your entire identity around, I'm someone who has to make this payment every month, no matter what. It sounds obvious, but the ripple effects are enormous. Think of it like putting on a heavy backpack. At first, you're acutely aware of the weight. Your shoulders hurt, you adjust your posture, maybe you complain a bit. But after a while, your body adapts. You forget what it felt like to walk without it. That's exactly what a substantial home loan does to your financial nervous system. You normalize the weight. Here's where it gets really interesting. When that anchor is heavy, like a mortgage payment that's 35% or more of your take-home pay, your brain doesn't operate in growth mode. It operates in don't screw this up mode. And that's a completely different psychological state that quietly shapes every career and financial decision you make for decades. That shift is the turning point. Because when your mortgage crosses a certain psychological threshold, it can silently block you from career moves, business risks, and life decisions that would have generated far more wealth than the house appreciation ever will. Let's break down what actually happens in your brain when you sign that 30-year contract, because this isn't just theory, it's measurable physiological change. When you don't have financial breathing room because your housing costs dominate your budget, your brain operates in what neuroscientists call chronic low-level stress mode. Research from Harvard's Behavioral Economics Lab shows that financial pressure literally reduces cognitive bandwidth. A landmark study by Malinathan and Shafir found that money worries can consume so much mental energy, it's like losing 13 IQ points. You're not suddenly dumb, but your brain is running background processes that drain your creative and strategic thinking capacity. Here's what's actually happening. When you're stretched thin by a mortgage, your amygdala, your brain's alarm system, stays partially activated. Meanwhile, your prefrontal cortex, responsible for long-term planning and creative problem solving, gets less resources. You become hyper-focused on not losing what you have instead of growing what you could have. Let me give you a concrete example. Picture someone we'll call Marcus. Before buying his house, Marcus was the guy who'd volunteer for challenging projects at work, network aggressively, and seriously consider job offers from other companies. After buying, he stopped raising his hand for risky assignments that could lead to promotion. He became less aggressive in salary negotiations because the fear of being let go felt unacceptable. The house didn't just change his finances, it changed his professional persona from risk taker to risk avoider. Here's the kicker. Marcus didn't consciously decide to become more conservative. His brain made that choice for him, operating from a place of, I cannot afford to disrupt my income stability. That's the survival mode talking. Now let's talk about identity, because this psychological shift runs even deeper than most people realize. When you get approved for a home loan, there's this massive identity transformation. You go from person building wealth to homeowner, and society treats homeowner like a graduation badge. You've finally made it to real adulthood. But here's where it gets psychologically dangerous. Once your identity becomes tied to being a responsible homeowner, it becomes much harder to make decisions that threaten that identity, even when those decisions would dramatically improve your long-term financial position. This is what psychologists call identity protection bias. Your brain will work overtime to defend the story you've built about yourself, even if that story keeps you stuck. You might hate your job, but you won't leave because I can't risk the mortgage. You might want to start a business, but you shut down the idea before it starts because I need stable income for the house payment. Think about this scenario. A friend, let's call her Sarah, wanted to transition from corporate law into something more fulfilling. Before buying her house, she was actively exploring options, maybe taking a pay cut for better work-life balance. After the mortgage, she stopped. Not because the opportunities disappeared, but because any income instability now felt unacceptable. The house transformed her from someone optimizing for fulfillment into someone optimizing for payment security. The identity shift is subtle but powerful. I'm building a life becomes I'm maintaining a payment. And that's a fundamentally different way of existing in the world. Let's examine how this affects your decision-making process, because this is where the opportunity costs get really expensive. When your mortgage consumes a large portion of your income, every decision gets filtered through the lens of, but what about the house payment? Research from the University of Chicago found that homeowners are significantly less likely to change jobs, negotiate aggressively for raises, or pursue entrepreneurial ventures compared to renters with similar financial profiles. Here's the psychological mechanism. When your fixed obligations are high relative to your safety net, your brain shifts into what behavioral economists call loss aversion mode. You'll work twice as hard to avoid losing what you have as you will to gain something potentially better. Instead of asking, what could this opportunity create? You ask, what could this opportunity cost me? Picture this common scenario. Your company offers a role in a different department. It's not guaranteed money immediately, maybe it's lateral, but there's significant upside potential. Before the mortgage, you might have tried it. Worst case, you'd pivot again. After the mortgage, your internal calculator immediately runs. Mortgage, utilities, insurance. I can't gamble with uncertainty. Or someone approaches you about partnering on a side business that needs upfront investment and time. You say no, not because it's a bad opportunity, but because in the back of your mind there's this mental spreadsheet of fixed obligations that can't be compromised. Here's the profound insight. The same mortgage payment that forces you to build equity might simultaneously force you to say no to opportunities that would have grown your income exponentially faster than 3-5% annual home appreciation. Before the mortgage, decisions driven by potential and curiosity. After the mortgage, decisions driven by fear of disruption. Sound familiar? Now let's talk about opportunity recognition, because a heavy mortgage doesn't just change how you evaluate opportunities, it changes which opportunities you even see. When you're financially stretched by housing costs, your brain literally filters the world differently. Instead of scanning for growth possibilities, you're scanning for threats to your stability. Behavioral finance research shows that people under high financial strain are less likely to invest in stocks, start businesses, or change careers, even when those moves are statistically favorable over time. Imagine a friend tells you about a startup that's hiring. The equity could be huge, but it's risky. If your housing costs are modest and you have a financial cushion, you seriously consider it. If your mortgage is suffocating you, your brain dismisses it in 0.5 seconds without real evaluation. Or consider temporary income reduction for a dream role, taking 6 months to retrain for a different industry. Or relocating to a city with better long-term prospects but lower short-term pay. A heavy mortgage quietly removes these from your mental menu. You don't even label them as options anymore. They become things other people do. Here's the powerful reality. When your fixed housing costs are too high, your world shrinks. Not just your budget, your imagination. The social and career impacts compound over time in ways that are hard to measure but impossible to ignore. Once you're locked into a mortgage, you also lock into a social script. There's pressure to furnish the place properly, maintain it to neighborhood standards, maybe upgrade your lifestyle to match your new homeowner status. According to the Federal Reserve's 2023 survey of consumer finances, nearly 40% of recent homebuyers report feeling house poor. Technically able to afford the payment but stretched too thin for much else. What happens when you're house poor? You start declining dinner invitations because restaurants feel too expensive. You skip industry conferences because the travel costs feel irresponsible. You avoid networking events that could advance your career because they require money you don't feel you can spare. Here's a real example. I know someone who got promoted and immediately upgraded to a beautiful house with a substantial mortgage. Instagram-worthy place, great neighborhood. But then they stopped attending professional development events because the $300, $500 felt too risky. They stopped taking courses because the investment felt irresponsible. 5 years later, their career trajectory had flattened while their peers who maintained flexibility continued advancing. The house gave them a nicer address, but a smaller professional life. That's the hidden trade-off nobody talks about. Looking at long-term compound effects, the picture becomes even more sobering. Social Security Administration data shows that for most Americans, their primary residence represents their largest asset. That sounds positive until you realize it means most of their net worth is trapped in an illiquid investment they can't easily access without selling or borrowing against it. Meanwhile, Vanguard and Fidelity research consistently demonstrates that diversified stock market investments, compounded over decades, typically outperform home price appreciation after factoring in maintenance, property taxes, insurance, and transaction costs. But because the mortgage feels like forced savings, people over-prioritize housing and underinvest in liquid, flexible assets. The long-term consequence? 30 years pass, and yes, you own the house outright. But you might have limited retirement savings, minimal liquid assets, and fewer career advancement opportunities behind you because so much energy went into protecting and maintaining the house payment. Here's where it gets really interesting. The most valuable asset isn't just the house or the investment portfolio, it's your income-generating ability. And a poorly structured mortgage early in your career often constrains the exact risks and moves that would have supercharged that earning potential. But here's where most people mess this up, and I see this pattern constantly. They focus on one question: can I afford the monthly payment? They plug numbers into online calculators, see that it technically fits their budget, and think they're good to go. Maybe the bank approves them for some large amount, and they interpret that as validation. Treating bank approval as life approval. Banks care about one thing: can you make the payment? They don't care about your peace of mind, career flexibility, or long-term wealth building. If the bank says we'll lend you $600K, that doesn't mean you should borrow $600K. Ignoring the life payment. You calculate the house payment, but not the cost of constrained career moves, reduced travel, delayed business ideas, and the stress tax on your cognitive capacity. That's the hidden bill most people pay for decades. Buying at emotional peaks. You fall in love with a place, the market feels crazy, everyone's saying buy now before prices rise more, and your nervous system just wants the decision to be over. So you stretch financially, justifying it as investment in your future. The consequences? You get the house but lose your breathing room. You become house rich, life poor, which is often worse than being temporarily house poor, options rich. This isn't about shaming anyone who's already made this choice. You were sold a one-dimensional story. But it is about adjusting your perspective from here forward. Let me reframe this entire conversation, because this isn't really about whether renting or buying makes more sense on a spreadsheet. This is about what kind of person you want to become and what kind of life you want to build. In the economy our parents lived in, stable jobs, predictable career paths, pension plans, homeownership made perfect sense. You got a job, stayed for 30 years, bought a house in your 20s, paid it off by your 50s. In that world, stability was rewarded. But that world is gone. In today's economy, flexibility is rewarded. The people building real wealth are those who can move quickly when opportunities arise, who can take calculated risks because they're not weighed down by enormous fixed obligations, who can invest aggressively in their skills and businesses because they haven't locked all their capital into an illiquid asset. Instead of asking, how much house can I qualify for? Start asking, what kind of life do I want to lead? Do you want to be the person with a beautiful house but constrained options? Or the person with a modest living situation but tremendous financial flexibility, what I call walking away money? Walking away money is the real opposite of being trapped. It's the buffer that lets you make choices from strength instead of fear. It's knowing that if your job becomes toxic, you can leave. If an amazing opportunity appears in another city, you can take it. If you want to start a business or take a sabbatical, you have the resources. Here's the opportunity cost framework. Every extra $500 you put into a bigger mortgage payment is $500 you're not investing in index funds, skills training, business opportunities, or simply buying back your time when you need flexibility. Culturally, we celebrate the person who stretches for the dream home more than the person who keeps costs low and builds optionality. But long term, the second person often has a dramatically better life. Now let's do a reality check with some actual math, because I want you to see the real numbers without sugarcoating. Let's say you're looking at two scenarios: a house that requires a $3,200 monthly mortgage versus a more modest option at $2,400 monthly. That's an $800 difference. Text time monthly difference times 12 text stack months clicks. $800 times 12 clicks, $9,600 text annually dollars. Over 10 years, that's $96,000 in additional housing costs. But here's where it gets interesting. What if you invested that $800 monthly difference instead, using historical stock market averages of approximately 7% annual returns? Text or future value Dazher clicks PMT times frac S1 plus RARN 1 starter dollar, where PMT war $800, R.0712, and war 120 months 10 year. Text R future value $800 times frax 1.07, 10 den 1.07 follower, text approximately $138,000. Over 20 years, that same $800 monthly investment could grow to roughly $400,000. That's not small money, that's life-changing flexibility. Or consider the total cost of homeownership. Take a $500,000 house with a $400,000 mortgage at 7% over 30 years. Text total payments ex text $2,661. times 360 iTextX months, ICE, $957,960. You're paying $557,960 in interest alone, more than the original loan amount. Add property taxes at 5% annually, $7,500/year, $225,000 over 30 years. Insurance and maintenance, relatively 1% annually clicks $150,000 over 30 years. And your $500,000 house costs approximately $1.3 million over 30 years. Meanwhile, that same money invested in diversified index funds historically would have grown to significantly more, with much greater liquidity and flexibility. These aren't small differences. They are life-altering amounts that represent decades of career flexibility you're trading for the psychological comfort of owning your shelter. So where does this leave you? Here's the core message. A home loan can be a wealth-building tool, but only if it preserves your psychological breathing room and financial flexibility. If it pushes you into survival mode, the real cost isn't just financial, it's the life you don't build because you're too busy protecting the payment. You're not behind if you don't own a home yet. You might actually be preserving one of your most valuable assets, your optionality. If you already have a heavy mortgage, you're not doomed. You just need to be more intentional about rebuilding flexibility through other means. This isn't about getting rich quick. It's about slowly becoming the kind of person who makes financial decisions from a place of strength and choice rather than pressure and comparison. Imagine your future self looking back 20 years from now. Do they thank you for buying that house at that price? Or do they thank you for keeping your overhead manageable so you could switch careers, relocate for opportunities, start something meaningful, or simply walk away from situations that weren't serving you? You can let housing costs quietly constrain your life choices, or you can flip the script, use shelter as a flexible expense while you build real wealth and options. The choice is yours, but make it consciously. You don't have to get it perfect. You just have to get it intentional.